believe the exit part of the equation is the most important part of the entire equation. And whether we are sitting with profits or we are sitting with losses, exit is the most important action of the entire investing process. As you rightly said, entry we can do at any point of time. A stock going from 100 to 1,000, you can enter at 100, you can enter at 150, you can enter at 200, you can enter at 400, you'll still make money. But a stock coming down, you need to exit at some, within some margin of error, so that you don't lose your entire gain, or that you don't lose your entire capital if you bought it at some peak. So exit remains extremely important. And usually in conventional investing, exit becomes a very difficult task, because conventional investing is made up of heavy research into that particular company. You buy a company after doing so much research into it, studying all kinds of its numbers, its vendors numbers, its clients, its products. You are doing all kinds of comparative analysis. By the time you are convinced that you have to buy this company and get it into your portfolio, you are totally married to it. And once that happens, then any shortfall in the company's performance or management issues or any governance issues, you feel that, okay, the company was good in the past, maybe it will recover, maybe it will come back, something good will happen. I have so much confidence on this company. You try to, or you tend to, sort of justify it to yourself that I must hold on because I should not book a loss. Booking a loss is the biggest impediment in any investor journey, because people don't want to book a loss. And in our case, we are very, very happy to book small losses. If you book a small loss, it means that you have been able to exit a proposition that would have given you deep wounds at a later stage. So you must attempt to keep only winners in your portfolio. As soon as you find that stocks in your portfolio are becoming losers, you need to get out and sort of evaluate that what is going wrong. I mean, from my perspective, my study is that the stock should have gone up, but it is going down. So if at that point you are not re-evaluating your proposition, that means that you are probably looking at a period where the stock may go 50% down, it may go 75% down, and at some point it will become very, very painful to hold it, even though if your initial hypothesis may be right that the stock has a lot of value. But the question is that the stock can remain irrationally low for a very long period, whereas your patience to hold it for that kind of irrationally long period may not exist. And hence, if there is an option where you can have equal or maybe even slightly lower returns, but with a lot less pain, my sense is that I would want, much less pain. If you are able to compound even at, 15% annualized, it can give you fantastic returns over a reasonable runway. But why one should, live in this uncertainty that I don't know whether my stock will perform or not, or have I bought it at the right price, and, how the fundamentals may change. Nobody can really control anything. It's a disruptive world that we live in. The average age of companies used to be 60 years, now it's down to 15 years according to some studies. So we age of disruption, and we need to have rules to get out when it's time to get out, and not wait. And usually what happens is that when you are able to realize that it's time to get out, it is often too late. That is what the history has shown us. So it is better to have small losses than have big losses, large chunks of capital going away. Take small losses, reevaluate your hypothesis and go in again if the stock goes up again. So my sense is that people are very afraid of, so the psychology is actually inverted, where if the stock starts to move up, people tend to become cautious and afraid of it. The stock will fall down. Whereas it should be the other way around. When the stock is falling after you purchase, you should be afraid at that. And the stock going up, you should be happy because the stock is moving in the direction that you wanted it to move in the first place. So this psychology that stock has hit 52-week high, stock has hit all-time high, so something bad is going to happen. This needs to totally change for your perspective to become momentum oriented. Because from our perspective, a stock which is hitting 52-week high, stock which is hitting all-time high, is the best stock to have, because the stock itself is telling you that it can go to much higher highs, it can become a multi-bagger, and the BBC, the Bhava Bhagwan principle is basically is that you don't need to research the stock. The stock itself is coming and telling you that please buy me. I'm investable because I'm showing you these characteristics. So this is what we basically think of how and because we stay in the strength, the drawdowns tend to become smaller. Of course, we do get drawdowns, but if the drawdowns are lower than the benchmark and your outperformance is higher than the benchmark, then the two put together give you a lot of magical returns.